At the bottom of a statement of cash flows, if you had any significant transactions during the period which would not affect your cash account but would make a large change to a line item on your balance sheet, you need to display that to users of your information. So let's take the following three examples for the Outdoors Incorporated. They are going to acquire $300,000 of building by issuing common stock. They are going to acquire $70,000 piece of land by issuing notes payable. And they're going to retire a $100,000 notes payable by issuing common stock in exchange. Well, how would the journal entry for the first one look? On June 1st, the Outdoors is going to issue that common stock of $300,000 in order to acquire a building. So whoever is selling this building, in lieu of giving them cash, they're going to give them shares of their common stock. And let's just assume that this common stock does not have a par value. What would the journal entry look like? You would increase the value of your building by the $300,000. You would increase your common stock by $300,000, and you would denote that you issued common stock in exchange for a building. Well, that journal entry is perfect, but it's missing one thing. It's missing cash. So you know this is a non-cash transaction because the journal entry you would use to record it does not include cash as either your debit nor your credit. Say on July 1st that the Outdoors acquired a piece of land worth $70,000 by issuing a notes payable. So they bought this piece of land for $70,000 and basically took out an IOU to whoever was selling it. How would that go on the books? As always, when you're buying something, the debit is to what you're acquiring. Land, $70,000. The credit is to how you're financing it. In this case, they're signing a notes payable for that same $70,000. In the journal entry where they acquired property by issuing a notes payable. And again, in this entry, cash is neither our debit nor our credit. On August 1st, the Outdoors retired a $100,000 notes payable by issuing common stock. So in this case, we're taking the liability off of our books, the notes payable. We are making it whole by giving them stock in lieu of cash. But if we're taking the liability off of our books, we need to debit it because all liabilities go down on the debit side. So we're going to debit notes payable for $100,000. We are going to credit how we are getting out of debt, which is by issuing them common stock for $100,000. And the journal entry to retire notes payable by issuing common stock. So in this instance, one more time, cash is not a part of our journal entry. If you get a line item on your statement of cash flows handout and you can't figure out if it should go in the main body of the statement of cash flows or in the non-cash investing and financing activities subsection at the bottom, the best thing to do is think out, would I use cash in this journal entry? And if the answer is no, then it should not go in the main body of your statement of cash flows. It should be listed in the non-cash section. And for the Outdoors Incorporated here, what they would do at the very, very bottom of their statement of cash flows, after they've determined their net increase or decrease in cash and showed users of their information, their cash balance from the last two periods, is they would display these items as non-cash investing and financing activities. And in total, they would display to them that they acquired $470,000 worth of things by doing something that was not transferring cash.